This is Futurebuilders podcast, and I'm your host, Teemu Uotila. I'm an enthusiastic future explorer working with a Finnish tech company. Together with my guests, we are building the future today. Are you in? This is Futurebuilders podcast with Aswath Damodaran, Professor of Finance at NYU Stern School of Business. He's the author of Dark Side of Valuation and an awarded teacher, fascinated by finance and markets. Together with him, we'll be finding out why companies should act their age, what are the foundations of a successful company, how to ensure your profits as an investor. In this episode with Aswath, we'll look into the present. Welcome to Futurebuilders podcast, Aswath. Awesome to have you here. How are you?
I'm very well, thank you. Glad to be here.
So a little bit about your background. You are teaching finance and valuation at Stern School of Business at New York University. You've written many books about valuation and corporate finance, and your blog itself, Musings on Markets, has been selected as a top stock market blogs in the world. And you are pretty much traveling around the world and telling people about how to do sane valuation and what to take into account when you...
Let me rephrase a little bit of that. I travel around the world and I don't tell people how to do valuation. I tell people how I've learned how to do valuation.
Yeah.
Because I think it's hubris on my part to tell others how to do valuation. All I can take them through is my experiences in valuation and say, this is how I learned what I did.
So what made you actually, in the beginning, what made you drive towards this kind of career as a professor and expert in finance?
Actually, I'm neither. I'm a teacher. I love teaching, and if I wasn't teaching this, I'd be teaching something else. So my first love is teaching.
Yeah.
Finance happens to be the place I teach, but to me, teaching is what drives the way I think, I do, I act. So it is my primary role is to be a teacher. And the reason I like finance is it's a unique mix of storytelling and number crunching, something you usually don't get in any other discipline. So I like numbers, but I also like to tell stories, and finance brings the two together. So my love of teaching drives what I do, and finance happens to be the place it's landed.
Yeah, I had a pleasure seeing you at a Nordic Business Forum in 2018, and it was definitely, you were the opening act, so to speak, in there, and it was very, very excellent, and especially this whole companies should be acting according to their age. That's very, very, insightful, having Larry the Liquidators and people like that in there. So how long did you, by the way, use to create that kind of concept when you think about companies and their age?
It's relatively recent. It was in 2013 or 2014 that I started thinking about it. And I did it in the context of listening to people talk about tech companies. And what I heard people say when they talked about tech companies is they acted like all tech companies were young growth companies. And I was struck by the fact that the biggest, most successful tech companies, the Apples, the Microsoft, the Intels of the world, were actually old companies, aging companies, middle-aged companies, very successful companies, but still middle-aged companies. So I started thinking about a way in which I could think about a company that went past the sector, because we're lazy as investors. We assign labels to sectors. For instance, we think of tech as young and utilities as old or manufacturing as old. But within sectors, now we're getting a lot more diversity. So I think from that perspective, I think it was useful for me to think about a construct I could use. And in this case, the construct was the lifecycle construct.
Yeah, and that's the narrative works really well in there. And one thing also is I also work in tech industry, but it's funny because everyone thinks that if you work in tech, you're very innovative, and if you work in, let's say, your heavy-duty machinery, you cannot be innovative company, and that's sort of like a very, very misleading in my mind.
As human beings, though, we like to attach labels to things because it makes our lives easier. We tend to think of people in a group. We do this even with our businesses. We assign characteristics to entire groups because it makes our life easier.
Yeah, we like to compartmentalize people and
Exactly.
things like
Exactly.
that. If you look about the owner's value, so in your mind, what do people get the most wrong when thinking about ownership and owning publicly traded companies?
I think first, when people think about owning publicly traded companies, they don't think about owning businesses. They think about making money on an investment. So most people, for them, owning shares in a company is not a part ownership of the company. It's a way of making money by buying today at a low price and selling at a high price. And
Yeah,
I'm completely okay with that as long as you're honest about it with yourself. So I think people who fool themselves are people who buy shares in companies because they want to make money in the next 6 months and then tell you that they want to think like owners. You cannot think like an owner when your time horizon is 6 months or a year. So most portfolio managers don't own pieces of businesses. They own investments in stocks and bonds that they want to sell in 6 months or a year at a higher price. Doesn't make them lesser people or bad people. But that is the nature of investing as opposed to going and buying a piece of a business that you want to build up over time.
yeah. If you think about looking at your site, in beginning of every year you gather this updated data there, and so what's sort of like 1, 2, 3 most interesting observations for our listeners that you have found out in recent times?
The first thing I found out, and I learned this very early in the process, is most of the rules of thumb that are out there. The rules of thumb that we talk about in investing. If you buy a stock for less than 8 times earnings, it's cheap. If a company has more than 30% debt ratio, it has too much debt. These are rules of thumb that were developed 40, 50 years ago in a very different world with very different sectors. And for some reason, the rules have survived. So people pass them on generation to generation saying, this is the rule. And what I've discovered with the data is most of these rules don't work anymore. So when somebody says a PE ratio less than 8 is cheap, I would be very careful about it because that might have been true in 1968, but it's no longer true now. So that's the first thing, is that the numbers often are counter to the rules of thumb. The second is we are more alike globally than we're different. I mean, people like to think that Northern European stocks are different from Southern European stocks, are different from emerging market stocks or US stocks. What I've discovered is if you dig down, the fundamentals that drive prices are pretty much the same around the world. We like to think we're different because then we can create special rules for ourselves. But the reality is we share more in common than we're different.
Yeah. If you look at the one thing that came to mind when you talked about that is when Dropbox made their IPO, I remember their CFO saying that they most likely never going to be profitable, which
Right.
to my mind sounds very very odd.
Yeah, that is odd. And that I think is one of the things I try to tell people in the new economy about. Because when I go to Silicon Valley and I talk to founders of companies, the first thing that strikes me when I talk to these young, very smart people is the arrogance that comes through, which is we're inventing a new way to run the world. You're the old economy, so don't tell us about what the end game for our business should be. We have more users, we're successful. And I point out to them that while initially that might be your measure of success, going for more users, more subscribers, more members, it cannot be your end game. Ultimately, you've got to build businesses. And if you look at technology, the most successful young technology companies are operated on 2 channels. One is delivering what markets want, show more users, more subscribers, more downloads. But on the other channel, the management of this company is working on making this company into a business. That's what separates Facebook from Twitter. They both had lots of users when they went public. Facebook, though, and you can take issue with how ruthless the management is, was very driven by converting those users into profits, cash flows, and value, because that's what a business does.
Yeah.
Twitter, though, got so lost in if we have more users, we should be more valuable, that they forgot about the fact that unless those users get converted into revenues, earnings, and cash flows, they're just users.
Yeah,
and I think a lot of young startups forget that you got to run the business to ultimately becoming a business. So when I hear a CEO say what the CEO of Dropbox did, my first reaction as an investor is say, look, I'm not buying your shares because you have no idea where you're going. And if you don't know where you're going, it really doesn't matter how you get there.
Yeah, exactly. And it also, strikes very odd in my mind because, you need to pay salaries for people. People have expenses. No one is there doing for charity. So that's highly odd.
But the reason these companies get away with it is the way they compensate employees is with shares. And they say, look, as long as the market keeps pushing up the price because we have more users, you're going to get wealthier. It's amazing how deep this delusion runs in companies. It's not just CEO, it's across the board. People seem to have forgotten the end game for a business is ultimately to make money.
Yeah, that's a very good point. And lately you also been talking about in your social media, for instance, about the buyback. So do you see buyback being a flavor of the month kind of a thing or being more significant in future?
I think it's a global shift away from dividends. And I'll explain why. Dividends actually don't make sense as a way of returning cash to equity investors in a company because by definition, equity investors in a company get whatever's left over. So if you're the owner of a business, what you get is whatever's left over after everybody else has been paid, which means that number should be different, varying, and it should be high in good years, low in bad years. The problem with dividends is they're treated like coupons on a bond. When you start paying dividends, you're supposed to keep paying those dividends in good times and in bad times, which has never made sense to me.
Yeah.
But the reason that practice developed was in the 1800s, stock markets were still nascent, but bond markets were already established. So when stock markets were first created, the way you got people to buy stocks was by making stocks look like bonds. So the way you made them look like bonds is you said, look, if you buy shares in my company, I'll pay you something that looks like a coupon, an interest payment. And here's the dividend. So dividends actually were born in the 1800s because that's how you got people to buy into shares in the first place. That was 1860, 1870. We're in 2019, where companies are uncertain about the future. Their earnings go up and down. Even the biggest, most successful companies of the world today can't count on making money for the long term because their businesses change so much. Take Apple, most profitable company in the world, but it's built itself on a smartphone that might or might not be there 10 years from now. And if you cannot forecast or predict future earnings, you can't afford to keep paying big dividends and tell investors I can keep paying those big dividends. So one of the shifts that's happening around the world is companies are stepping away from those fixed dividends to something that's more residual, something where the number can change year to year. Buybacks are a way of returning cash to stockholders on a cycle that's more appropriate for you. So in a good year, you can buy back a lot of stock. In a bad year, you don't buy back any stock and people don't bat an eye. So I think this is more of a global shift away from something that should never have become institutionalized in the equity markets, which is a fixed dividend.
Yeah.
So unlike many people, I don't view buybacks as this insidious, horrific phenomenon that is going to destroy companies. I do think there are some companies that should not be doing buybacks that are simply because everybody else is doing it. But that's going to be true for almost any corporate finance practice, not just buybacks.
Yeah, and of course, once one big company starts doing buybacks, then others might follow just because one bigger one is doing.
In fact, I tell people there are two big forces in corporate finance. The first is Me Tooism, which is I want to be like everybody else in my sector. The second is inertia, which is if I've been doing this for a long time, I don't want to change. Those two forces explain 90% of what you see companies do. It's not some deep corporate finance thinking that's driving companies. It's Me Tooism and inertia.
Yeah. You were talking about this dividends. So could it sort of be summarized in a way that if company is paying dividends, it's taking away from the company's innovation budget and evolution in one way?
Yeah, that's true. Anytime you return cash to investors, that's cash you're not investing back. But let me ask a follow-up question. Is it good for companies to invest back? Well, for some companies, the answer is yes. But for a lot of companies, their good days have come and gone. It ties in very neatly to what I talked about at the corporate lifecycle. If you're a young growth company with lots of opportunities, I agree with you. You should not be returning cash to shareholders. You should be putting that money into innovation, growth, new investments. But if you're GE or Merck or any of the top, those 100 large old companies out there, Volvo, Volkswagen, let me ask you a question. Do you really want these companies innovating, or would you rather that they pay them that cash out as a dividend and you took that cash and invested in some young company that's actually innovating? One of the things about old companies trying to innovate is that the payoff seems to be much smaller. Why? They're more risk averse, they're more to lose, they worry about product cannibalization. Clayton Christensen actually had a very interesting thesis he put out 25 years ago. He's a Harvard Business School strategy guru. And basically he said disruption never happens through the status quo. It always comes from companies that have nothing to lose, small companies, young companies. The online retail business was not created by Barnes & Noble. It was created by Amazon, which in the late 90s had nothing to lose. So I think it's good that mature companies give the cash back and not try to innovate, because their innovation doesn't seem to have the same payoff that innovation at a young growth company, which is where this money goes anyway.
Yeah. You touched briefly about these big tech companies, Amazon, Facebook, Google, and Apple, such companies. Which one do you think, in your, from your investor perspective, which one has the most sound tactic to survive in the future?
I'll tell you, the scariest company on the face of the earth is Amazon.
Yeah, I have to agree.
Yeah. And it's scary because everybody is fair game. I used to think Amazon was an online retail company. I no longer do. I call Amazon a disruption platform. What they have is the capacity to disrupt any business on the face of the earth. And you know how it shows up? You go into any company and you ask them to list out their 5 biggest worries, 5 biggest competitors. Amazon shows up in almost every list. Google and Facebook view Amazon as their biggest threat to the online advertising business. Apple views Amazon as a potential threat to its smartphone business. Netflix views Amazon as its biggest threat for its streaming business. JP Morgan views Amazon as its biggest threat in the financial service business. Every company, lots of different businesses, Amazon is always there. I think if I were to pick one company which would ride through the storm and emerge on the other side as dominant, it's Amazon, because what they have going for them is they're incredibly patient. It's built into their DNA. They're more patient than any other company that I've ever seen in history. They're willing to wait for as long as it takes to change a business, and they always enter with that end game of changing the way business is done.
Yeah, they're not focusing on making huge amounts of profits, but put it all in growth and getting into new sectors.
Well, eventually they might. I mean, there's an end game. With Amazon, I don't think it's like Dropbox, so they don't care about making money. They care about making money. They're just going to wait.
Yeah.
Until it's time.
So
I'd be very scared if I'm an Amazon customer paying $129 for Prime. Is one of these days that might be $1,299. So and there's
because there's no one around. So
exactly.
Yeah. Regarding these sort of like emerging stocks and owning them, how do you perceive those? That because they are moving in a direction that no one has done before. Let's say CRISPR or canopy growth. With how do you evaluate those kind of?
Well, I think you can value them, but you have to accept the fact that your valuation is going to come with a lot of noise, estimation error, because you're making predictions about a future market where lots of things are unknown.
Yeah.
Nothing you can do about it. But there is one thing you can do as an investor to protect yourself. Don't put all your money in canopy growth. That would be a horrifically bad idea. If you're going to go with these young growth companies, nascent companies, you got to spread your bets.
Yeah.
You got to do your homework. You got to value your companies, but don't let hubris say, hey, I did my homework and this is the best company. I'm going to pick the 25 best companies. So if you're creating a portfolio of young companies and you've done your homework, remember the way this is going to pay off is that not all 25 are going to go up. That's never going to happen. But if 5 of the 25 take off, they're going to take off so much that your overall portfolio is going to do fine. This is a game. I think of it more like investing in out of the money options where you don't make money on most of them, but the ones you make money on, you make so much money, it makes up for the rest. That's the way you got to think about investing in these young companies, is spread your bets and do your homework.
Yeah, that's definitely a good advice. Regarding organization, when they do this, their fiscal reporting and such, they all say that they wanna grow and they wanna be innovative. But when you look at the data and the numbers, they are all sort of like flatlining. So why do you think organizations wanna live in this kind of a lie that they wanna believe in themselves that they're gonna grow?
Well, I don't blame them. I blame business schools on the one hand, because if you look at Harvard business case studies, who do we glorify? We don't glorify companies that have shrunk and acted their age. We glorify companies that have grown and become these behemoths. When we look at Hollywood, that's the other group that I blame. You think about who we make heroes. The CEOs we make heroes are the Steve Jobs of the world, right? People who built empires. We glorify empires and empire builders. So in a sense, when a company says we're beyond our growth days, we view that as an admission of failure, when in fact, it's an acceptance of reality. And I think until we as investors, we as human beings are willing to accept the fact that, sometimes it's the right thing to come out and say, look, our glory days are behind us. We're not going to shoot for the moon anymore. We're going to act our age. And we accept that. Companies are going to continue to do what they do right now, which is to act like they're growth companies well past their due date.
Yeah. Do you see that sort of like even the Roman Empire fell at that, if you take that?
I think it's a very dangerous problem, because if you ask CEOs of mature companies to keep going for growth, they act like casino gamblers, right? Because basically, what are they doing? They're putting all their chips in a number and saying, please, God, let it pay off, because if it does, I'm the next Steve Jobs. So I think we're creating a world where we're encouraging CEOs, and I shudder to think how the auto CEOs are going to play out the next decade. Because we're not careful, they're going to take everything that they've built up over 100 years and lose it all over the next 10, trying to put their bets on a number that might not pay off.
Yeah, and I've also seen this kind of, when you do next year budget or something like that, there's usually a magical number, let's say that we want to grow 20%, and no one really realizes where the 20 comes from. So it's very dangerous in my mind to fixate it on some certain number and try to stick to that. And
it gets worse, because once you put the number out and you're a publicly traded company, it starts to get built into expectations. And then you try to deliver those expectations, often by doing crazy things like laying off some of your best employees because it brings your costs down and makes your earnings actually grow 20%. You're mortgaging your future and your value to deliver these expectations that were completely arbitrary. But you just made up the 20% as a CEO. Now you got to deliver it.
Yeah, it's sort of like the short-term gain, but in long term, you're gonna definitely ruin the company. What about if you look at companies that rely heavily on, let's say, organizational culture and people and don't own any IP? How do you see their role when, thinking about how sustainable they are in this kind of world?
I'll give you a kind of a sector-specific story to illustrate why I think it's so important that companies hold on to their culture. I started, first going into investment banks about almost 40 years ago, in the early 1980s. And in the early 1980s, when I walked into an investment bank, I could always tell which investment bank I was in without looking up at the name on the board, because each bank had its own culture. Solomon was full of traders. J.P. Morgan was, white shoe bankers, conservative. So each investment bank developed a culture, and it attracted people who liked that culture.
Yeah.
Then in the 1980s, investment banks did something very stupid in my view. They decided to compete purely based on salary and pay. And they said, who cares about culture? I'm just going to pay the highest pay, and then let culture kind of deal with itself. And in the process, they've almost destroyed themselves as institutions, because now what you have are a bunch of free agents. And who can blame the employees for being free agents? who keep looking for a higher pay. So that's why you see entire groups in investment banks often leave the investment bank and go to a different one because there's no culture holding them together. So I think it's important that companies create a culture. The only problem is that culture has to reflect the world we live in. So a culture that worked in the 1960s or 70s might not hold 35-year-olds who come up through a very different culture. Your culture has to evolve and be alive. It can't be some static culture that was created. So Walt Disney, if Disney said, look, we're going to go back to the Walt Disney culture of family values, and they're going to have a really tough time holding on to 25. They might end up with a bunch of 70-year-olds who like that culture.
Yeah.
So you've got to have a culture, but you also have to think of that culture as a dynamic thing. Because I'm convinced that if Walt Disney lived today, the culture you'd create would be a very different one for Disney than the culture he created in the 1960s. So you can't hold on to cultures that were created 40 or 50 years ago. You got to have a dynamic culture that reflects the world we live in.
Yeah, and there was actually this Forbes study, I think it was a couple of years or 3 years ago, when they did this. They asked about U.S. people or working class people that which one would they rather choose to get a salary raise or fire their boss. And I think it was 65% would choose rather firing their boss than taking a salary increase. So it was also very interesting.
It shows something about organizational dynamics. Yeah,
yeah, that you don't want more money, you want better people in there.
Yeah.
If you look about young people nowadays and how do you perceive them? Do they care about owning things that much as the current and older generations?
They do, but they get rid of their things much faster.
Yeah, so
they care about owning things a lot more than we did. They just they seem to have no loyalty to the things they own. So that's a problem for companies now, because in a sense, in the old days, a customer would try your product and they liked your product, they would be loyal to your product. Today, that loyalty is frayed. I mean, that's why Apple's so terrified. Is today you love your iPhone, tomorrow you might love your Android.
Yeah.
So that people like owning things, but they also like changing what they own constantly. So you buy a house, you want to shift to a new house in 2 years. You buy a car, you want to have a different car in 3 years. You buy a smartphone, you want the updated smartphone next year. So I think it's a different culture, but companies have to adapt to it.
Yeah, definitely. The rotation of owning things much faster, and that's definitely true. How do you yourself perceive? How do you should educate young people on markets and capital ownership, things like that? How do you teach younger generation in your classes, for instance?
You teach by example. I've learned that lecturing people doesn't work. So I tell people, this is what I do. I'm not going to tell you that this is what you should do. And what I'm hoping for is they will hear the words, and initially all they will be is words. But over their lifetime, they will have experiences, or hopefully these words will come back to them. I'll give you an example. Tomorrow in class, I'm going to talk about how important it is when you're an investor not to concentrate your portfolio in 4 or 5 stocks. And I'll tell them why. And I'll tell them not as a lecture, as you should be diversified. I tell them, look, I own 53 stocks, and here is why I own 53 stocks, and here's how I've built to 53 stocks. And then I leave it at that. And many of them will listen and say, you know what, I can pick the 3 best stocks. And they will. And there will be a day where one of those 3 stocks is going to drop by 50%. And hopefully on that day, they will hear the words that I said about, hey, maybe you should spread your bets. So what I'm hoping for is to plant a seed. That seed, with experience watering it, will turn into a tree which hopefully will make them better investors. I do this with my own kids. So I treat anybody that I talk to the same way I treat my kids, which is I'm not going to tell them what to do, because that's not going to stick.
Yeah, you're going to restrict them, so they're going to do opposite.
Exactly. So because in a sense, all I can do is say, this is what worked for me. I'm not saying it'll work for you, but take it into account.
Yeah, definitely. Yeah, so I think we covered pretty much on the present day of things, and now we can move into the future stuff and how things are gonna form in there. You just listened to Futurebuilders podcast with Aswath Damodaran, talking about the present. Tune in for our next episode where we look into the future. The future is here tomorrow. Join the discussion on our LinkedIn page, We Are Future Builders, and listen to more Future Builders podcast on wearefuturebuilders.com.